Hey, welcome. If you've ever just stared at a trading chart feeling completely lost and overwhelmed, you are in exactly the right place. Today, we're going to cut right through all that noise and reveal the two essential indicators that the pros actually rely on. So let's get into it. Just look at any trading platform, right? You're flooded with hundreds of technical indicators. You've got your RSI, your MACD, Bollinger Band, Super Trend. Seriously, the list just goes on and on and on. And if you're a new trader, it's completely paralyzing. Which ones do you pick? More importantly, which ones actually matter? There is a perfect phrase for this feeling. Indicators ka jungle hai. It's an indicator jungle out there. And it's so common for beginners to just slap 10, maybe even 15 different indicators on their charts. You're hoping to find some kind of hidden secret, but you just end up more confused than when you started. But listen, here's the secret. While all the beginners are getting lost in that jungle, most professionals, they simplify. They don't use dozens of these flashy, complicated tools. Nope. They rely on just two core indicators to really make sense of the market. And today, we're going to break down exactly what those are and, more importantly, why they work so well together. So why do we even do this? Why do we overload our charts in the first place? Well, it all comes down to basic human psychology. We're all searching for that magic formula, right? That one perfect signal that's going to guarantee a winning trade. We think that more data has to mean more certainty. But in the world of trading, the opposite is usually true. And that clutter creates this terrible domino effect. First, your charts get so messy you can barely even read them. This just creates an overwhelming amount of noise, making it impossible to see the real signal. And buried under all that noise, you completely miss what the price itself is trying to tell you. And all of this leads to that one terrible place, analysis paralysis, where you're so overwhelmed, you can't make a decision at all. Okay, so before we even get to our two magic indicators, we have to establish the most fundamental rule of charting. The single most important signal on your screen isn't an indicator at all. It's the price, plain and simple. And this is the point that you have to get. Every single indicator, no matter how complex it looks, is just a derivative. It's nothing more than a mathematical formula that takes old price and volume data and just repackages it. Indicators follow the price. They don't lead it. Price is king. So let this one really sink in. If you can't understand the story that a clean, simple price chart is telling you, the trends, the support, the resistance, then I'm telling you, no amount of colorful lines and fancy oscillators is going to save your trade. You have to start with the source of truth, and that is the price itself. All right, so with that crucial foundation in place, let's pull back the curtain on our first essential tool. This is the one you use to answer the most basic yet most important question in trading. Which way is the market going? This, my friends, is the moving average. It's our trend finder. So what a moving average does is it takes the average price over a certain period, let's say 50 or 200 days, and it plots it as a single smooth line on your chart. Now, there are different types, sure, like simple or exponential, which pros often use because it reacts a little faster to recent price changes. But their core job is exactly the same. Filter out all the random noise and just show you the underlying direction. I absolutely love this way of thinking about it. A longer-term moving average really is like the market's heartbeat. It's its pulse. It gives you this constant, rhythmic sense of the market's overall health and its direction. It's a fantastic visual. And using it is just beautifully simple. Is the price consistently trading above that moving average line? Guess what? You're in an uptrend. Is the price consistently trading below it? You're in a downtrend. It's a super clear, visual rule that helps keep you on the right side of the market. Okay, so the moving average tells us the what, the direction. But that's only half the story, isn't it? Now we need to know about the strength and the timing of the moves within that trend. And for that, we turn to our second essential tool, the RSI. This is our momentum gauge. So the Relative Strength Index, or RSI, is what's called a momentum oscillator. In simple terms, it just measures how fast the price is moving up or down, usually over the last 14 candles or so. It's basically telling you if the current trend is still picking up steam or if it's starting to run out of energy. Now, the classic way to read the RSI is with these two key levels. If you see a reading above 70, it suggests the market is overbought, and it might be due for a little pullback. A reading below 30 suggests it's oversold, and it could be ready for a bounce. Think of these as your potential zones of action. But here's where the real pro insight comes in. The true power of the RSI isn't just about those simple overbought or oversold levels. It's about finding something called divergence. This is when the price is making a new high, but at the same time, the RSI is making a lower high. It's like a car's engine revving lower even as it's trying to climb a hill. That mismatch is a huge warning sign that momentum is fading, and a reversal could be just around the corner. So now we have our two tools, one for the trend and one for momentum. But the real magic isn't in using them by themselves. It's about how they work together, how they complement each other to give you a much, much more complete picture of what's happening. Let's see how this all comes together. And this table just perfectly illustrates their synergy. The moving average answers the what question. What is the overall trend? Which way is the river flowing? Then the RSI answers the when question. When is the momentum right to maybe think about making a move? Is now a good time to act? See? Trend plus momentum. It's a simple, clean, and incredibly powerful combination. Now look, having the right tools is a massive step forward, but it is not a guarantee of success. In fact, it's incredibly easy to misuse these tools and make some really costly mistakes. So let's make sure that doesn't happen to you. Here are two simple rules to act as your guardrails. Number one, always check the trend with the moving average first before you even glance at the RSI. The trend is your guide. And number two, never act on an RSI signal alone. For example, if the RSI hits 30 in a really strong downtrend, don't just blindly buy. Wait for the price itself to show you some sign that it might be turning around. Confirmation is everything. So let's bring this all home. We started in that jungle of confusion, right, with dozens of indicators pulling us in every direction. But by focusing on first principles, on what really matters, we've arrived at a place of simple, powerful, and actionable clarity. And this is the most important takeaway. Your goal as a trader shouldn't be to learn every single indicator out there. Your goal should be to achieve deep mastery of these essential two. Stop chasing the next shiny new tool and instead focus on mastering the core concepts of trend and momentum. And the benefit of this focused approach? It's huge. By simply clearing the clutter from your charts and mastering the moving average and the RSI, you're not just improving a little bit, you are putting yourself 10 times ahead of the average retail trader who's still lost back there in the jungle. Simplicity is your new competitive advantage. So the final question is for you. This explainer has given you the map out of the jungle. Now you've got a choice. Are you going to commit to mastering these two essential tools to finally find clarity in your trading? Or are you going to go back to getting lost in the noise? The choice is yours.